Well, we're in the middle of tax season, maybe past tax season when you watch this, and everybody is filling out their 24 returns. That's just one piece of the puzzle. Right now, you can start planning ahead for 2025 and take advantage of the new tax rules that are in place. If you aren't sure what those are, we're going to talk about them coming up now. Welcome into Perfect Game Retirement. Ben George with Ryan Ledden, certified financial planner, also the owner and founder of Black Oak Asset Management. And Ryan, taxes are a big piece of what you do. Every year, are you keeping an eye on changes that come down? I know this is something that as an advisor, I'm sure you're always staying on top of the news and the laws and the changes, right?
Yeah, absolutely. I mean, we don't prepare taxes here, but we do partner with a firm that does prepare the taxes. And as an advisor, you got to be careful with what you say about taxes. But we know the tax law. We know contribution limits. We are allowed to speak on those things. We just quote unquote, the tax advice is what you have to be careful with. But again, that's why we partner with a firm who does that. So if we have questions, we go directly to them. Obviously, some of our clients have great CPAs that they work with. I work with a CPA firm that's not the firm we partner with, and they are awesome. I wish I could refer everybody to them, but you just kind of see a common occurrence now with CPAs and CPA firms. So if you've got a good one, stick with them. But there's a lot that don't take any more clients. There are many that are retiring and just closing their doors. So they're hard ones to find that are really good tax preparers, but you want a tax planner as well, especially from a small business owner standpoint. There's so many things to take advantage of, obviously legally to take advantage of, and that's why I lean on the firm that I do. I'm very knowledgeable on the planning side of taxes, but they know way more than I do, so I defer to them and let me know when there's some things I can take advantage of.
Yeah, and if you want to, get a recommendation or find out, who's a good person to work with for your taxes, if you're looking for that help, again, go to speakwithryan.com. You can schedule a time to sit down and chat. All right, so we're going to run through this again. There's higher standard deductions, increased retirement contribution limits, some updated HSA rules we're going to go through, but plenty of opportunities to lower your tax bill and hopefully boost your savings here in 2025 and beyond. So let's just start with the tax changes for 2025 that people need to pay attention to.
Yeah, like you said, the standard deduction, like finally there's an even number when it comes to the standard deduction. So if you're married filing jointly, it's just an even $30,000. It's always these weird, quirky numbers that are based off of cost of living and inflation and all that. So it usually adjusts every single year. So, kind of looking at my notes here to make sure I'm not misquoting anything. But yeah, it was $29,200 for married filing jointly. This year, it's an even $30,000. And again, that's what they call the standard deduction. So many of you already know what that is, but there are some that I ask that question: do you itemize or do you use a standard deduction? And sometimes you get people kind of pause for a second, like, wait a minute, let me think about this. And I think they know, but it's just not common nomenclature that I can't believe I just said that word. That goes back to my Latin days in high school. Taking 4 years of Latin, which it finally came through on this show, but it's just not common that we use that. So I itemize because as a small business owner, there's many things that I can itemize, which means I go through and I turn in these reports every single month to my CPA firm, and they keep track of that. So I'm not doing like giving them a giant shoebox at the end of the year going, okay, here's all my stuff. No, they keep up with it on a monthly basis, and I turn those things in. So, but because the standard deduction is so high right now, if you're in retirement and you have a paid for house and really the only deduction that you have is maybe charitable giving, you're probably just doing the standard deductions. So it's kind of easy math when it comes to that. So, and again, $15,000 for a single filer, which was last year, it was $14,600. So if you're over the age of 65, even you get an extra standard deduction in there. And then for 2025, it has increased. In 2024, it was $1,950 for single filers, and then an additional $1,550. It's gone up by a whopping $50 for each one. So not very much, but it's an extra standard deduction on top of the large standard deduction that we do have. So those things continue to inflate. We'll see in 2017 before the standard deduction was half of what it is. So that could be something to keep our eyes on as we see what the tax code is going to be for 2026 next year. What's that standard deduction? Is it cut in half, which it's set to do if nothing is done? So right now it's $30,000 for married filing jointly. It will be $15,000 married filing jointly, give or take a few dollars here or there, if nothing is done. So something to keep your eye on for 2026.
Yeah. Okay. And again, beyond tax changes, there are a lot of savings opportunities too, some changes to contributions. So let's start with the 401k, Ryan. There, again, these might seem like small changes, but you are able to invest a little bit more in your 401k this year.
Yeah, an extra $500 for those who are under the age of 50. So it's $23,500. And yeah, you're right. It's only $500, but you need to be aware of that. Let's say you're a math nerd and you have timed out your percentages so that you basically max out at the very end of the year. You want to spread out your contributions over the course of the whole year. Well, if you don't factor in that extra $500, you won't get that $500. So you need to be aware of those adjustments. So $23,500. If you're over the age of 50, there's an extra $7,500 that you can put in there. So that equals $31,000 of just your contributions. That does not include any matching dollars or profit sharing. Does not include. That's just the employee, or what I call the EE, the employee. That's your contributions. The ER, or the employer, that's on top of that. So that is not, and I hear people say all the time, oh, I'm maxing out my 401k. Like, does that mean you're getting the full max, or are you literally maxing out your 401k? Maxing out your 401k is putting in $31,000 if you're over the age of 50. Where there's a new little catch this year, if you're 60 to 63, it's not just $7,500, it's $11,250 that you can put on top of that. So a lot of people don't know that. So from 60 to 63, where they came up with these ages, I don't know, but they did. It's an extra $11,250. So the employee, if you're between 60 and 63, is $34,750 of employee contribution. So make sure you're aware of that.
Yeah, I'd love to be in the room when they're having discussions with like 72 and a half, 73 and a half. Yeah. Let's go up $200 this year. I'd love to hear the conversation behind that. Along with the 401k, the IRA, another thing probably interested in, but no changes there?
No, pretty boring this year. It's been going up pretty consistently. And again, there's no rhyme or reason. I remember when I first got in the business, it was usually like 4 and 5 years between it when it go up by $500. So this one inches up a little bit slower, if you will. I wish it didn't, but it does inch up a little bit slower. So no changes. $7,000 for those under the age of 50. The extra $1,000 or the catch up is $1,000, or you can put in $8,000 per person.
All right, then one more, the HSA, the health savings account. Those contributions limits did go up, right?
Yeah, they went up by $150. Still, I really wish this one, because we talk about all the healthcare issues that we're going to have, and the cost, and how broke Medicare is going to be one day, or Medicaid. I wish they would allow people to save more into these vehicles. So yeah, it's an extra $150. It's $4,300 per person in an HSA. Love HSAs. They're a triple tax benefit. You put them in pre-tax, they grow tax deferred, and as long as you use them for healthcare needs, they're tax free. So even the Roth is not a triple tax benefit, because you don't get that first tax benefit. There's no tax deduction when you put money into a Roth IRA. It grows tax deferred and take it out tax free as long as you meet the rules of it. But at HSA, same thing. If you meet the rules of it, again, pre-tax, tax deferred, and tax free as long as you use it on healthcare expenses. So wish they would jack up that number to make it more accessible for people.
Yeah. All right. So those are the changes and things to be aware of this year. Which of those, Ryan, of the things we've discussed, do you think will have the biggest impact for people?
I think it's the 401k for those ages 60 to 63, because it's just, again, I don't think that made a lot of headlines, and I know it's not a huge amount of money, but it's still, those are your big savings years that, you're getting closer to retirement. Maybe you have all your kids off the payroll. You're not paying for college anymore. So those are those years that you need to be plowing money away if you have a certain time frame when retirement. So the government is giving you this advantage to do it. So why not take advantage of it? And that includes 401ks, whether it's pre-tax or post-tax. So you can put Roth money in there up to 34,700. So take advantage of that versus a Roth. Outside Roth is only 8,000 for someone who's over the age of 50 versus 34,700. And inside of a 401k, the income limits don't apply there. So yes, please take advantage of that. Probably the next one is probably the HSA, but I would definitely say the 401k for those ages 60 to 63.
All right. Well, listen up on this question. There are probably some people that haven't been proactive with their tax planning, but maybe are starting to kind of think that way and watching this video, looking for some ways in which they can be more proactive. What's one simple step they can take this year to help optimize their tax situation?
Yeah, one is finding a good CPA and a tax planner. Again, we can certainly help with that, but I think that's the first step. And even again, people we work with, and it's not just us. There's other advisory firms out there that have tax planning software. I mean, the software that's out there now. I mean, you upload your tax return, and it scans it, it goes through it, and it will look for opportunities like, hey, you could be doing this, or you could be doing this. Now, that's not taking the place of a good CPA who's a tax planner, but that's the first steps, is just making sure, because this tax code stuff, it changes all the time. And so to make sure you're ahead of it, I'm not saying people can't do it on their own, because obviously there's tax planning software that can help people with maybe simple returns. But for me, for peace of mind and knowing that there's maybe things I'm not taking advantage of, my humble opinion is to pay someone to help you with it.
All right, very good. Well, a lot to think about and consider for 2025, but hopefully this gives you a leg up on the new year, and hopefully you'll be in a better position moving forward. But if you have any questions, please reach out, speakwithryan.com, the best way to get in touch with Ryan at Black Oak Asset Management. But also subscribe to this channel. I'll have more educational videos, information moving forward, and hopefully these videos and this channel helps you out. So we appreciate the support, and thanks for Ryan for breaking this all down for us.